Choosing your mortgage based on the lowest interest rate is a big mistake. For too long, we've been fed this easily consumed narrative. But today we unveil how wrong this truly is and show you how to succeed in paying off your mortgage. Josh Vecchio, mortgage broker with Hunter Galloway here, and in this video we're going to uncover the 5 ways to pay down your mortgage and show you why purely relying on the lowest interest rate won't save you. Step by step, so keep watching. And remember to hit that subscribe button and keep up to date with all the latest property and finance. 1. Fixing your interest rate. With fixed rates so low at the moment, it's so easy to get caught up in the bank's bravado. Think about it this way. If you were at the casino, you know full well that the odds are stacked against you. Well, with fixed rates, it's no different. And essentially, it's your bet versus the bank's. When you fix, the bank wins if the variable rate tracks under. So, for example, if your fixed rate is 4% over 3 years and the variable rate is under this for the majority of the 3 years, then the bank makes margin on the difference. If the bank gets it right, they make profit. If the bank gets it wrong, they lose money. If you know anyone that's fixed their mortgage in the past, ask them if they've won this bet. 9 times out of 10, they'll tell you that they didn't. Therefore, if you're looking to fix your interest rate in, you must relegate rate to the side and consider a fixed rate really for the following reasons. Whether it's for stability or the ability to budget so that you know what your payments are and they won't change over the extended period. To fix in your mortgage purely based on rate is a big mistake. So remember this if you're thinking about fixing your home loan in. 2. Rate creep. So now you're not looking to fix in your mortgage perfect. Well, the next thing you'll need to contend with is a thing called rate creep. This essentially happens when the variable rate increases ever so slightly over time. It's very common for this to happen, and banks generally offer variable rates with a discount, which over time decreases. This means that at any point in time, even if the market is stable or going down, that your rate can and will increase, as the banks have the ability to reduce your discount at any time. So whilst you might be getting a mortgage with a bank who's offering the lowest rate at the time, over time, you might actually find that it's higher than if you had gone with a bank who was offering a competitive rate, but not the lowest. The way to guard against this is to use a reputable lender. Typically, the smaller the provider, the higher the chance of rate creep. Yes, all banks do this, there's no doubt about that. But it's the smaller providers which, in my experience, do this much quickly. And there are a variety of reasons why this happens, from the cost of funding to market share. Because essentially, if you've got 0.1% of the market, well, it essentially means that you're less likely to end up on the news because the relative size of who was affected are insignificant compared to that of a major bank with a market share of say 15%. This is why choosing your bank purely based on the interest rate is a big mistake, because where you begin and where you end are 2 completely separate things. However, there's still something you can do to avoid this having an impact on you, and it's ultimately by managing your money, which brings us on to our 3rd tip. 3. All-in-one banking. The goal of having a mortgage is that one day you won't have one. Think of a mortgage as training wheels for a bike. It allows you to get on the bike, but your vision should be for one day to be able to ride free and without its aid. Here's a question for you. Who's going to pay more interest? The person with the lower rate, who pays off their mortgage over 30 years, or the one who has a competitive rate, not the lowest, but pays off their mortgage in 7? Well, the answer's obvious. It's the one who pays off their mortgage quicker, who pays less over the term. So to get the training wheels off, the goal with your mortgage is to simplify. Rather than having your mortgage with the bank, your credit card with another, savings somewhere else, and an everyday account yet with another bank, you want to consolidate it and keep it all with the one provider. By having it all in the one place, it makes it much easier to get the most out of your money. The way mortgages are paid off are through additional payments, not just the lowest interest rate. And what typically happens is that people refinance their mortgage to get a lower rate, but rather than using the money which they've saved towards paying down the loan, use it to further their consumption. Here's the deal. Paying off your mortgage is a simple formula. Earn more, spend less, save more. I'm afraid there's no secret technique, and both time and effort is required. And these are BYO. Bring it yourself. So if you haven't already, you'll want to implement these 3 things straight away. Firstly, if you don't have a budget, it's time to get one. The only way you'll know if you're on track is to see if you're off track, and budgeting will create a framework which will allow you to know if you're achieving your goals and ensure that you're working towards something. The second thing you want to do is create buckets. We talked this in great detail in another video, and we'll put a link below, and the video title was How to Save a Deposit. And finally, once you've got everything set up, you want to schedule an hour a week to review how everything's going. This will allow you to make small adjustments each and every week, and thereby optimizing how your money is working and ensuring that it's working for you. 4, be under your limit. If you considered getting married, would you do so at the spur of a moment? It's not like you just rock up to the first person you thought was mildly attractive and say, "Hey you, let's get married." Yeah, sure. I know I just met you, but I have a pretty good feeling this is gonna be a long and happy marriage. I mean, come off it. We're not living in the 1850s anymore, and both parties have the right to leave the marriage at any time. And I guess that's why Married at First Sight is such an entertaining show. It's because we all know these couples are doomed to fail from the outset. Like marriage, jumping into a mortgage is a huge commitment, and it's best to get comfortable before making the leap. So rather than rushing in, spend the next 6 to 12 months in getting to know what life with a mortgage really is like. Enjoy the courtship and learn a little bit more about each other. That is, the mortgage, I mean. So before jumping into the deep end, here are my 3 big tips. The first is to set yourself up with a mock mortgage. And it's just that, a pretend mortgage. Wed yourself to a mock mortgage between 6 and 12 months to see how life really is with a mortgage and whether or not it has a big impact to your lifestyle. We've created a calculator and you can use this. The link is below in the description. The second is to only use 30% of your net income towards your mortgage payments. The only way you're going to pay off your mortgage is by being under your limit so that you'll be able to make additional payments. These payments are in what will set you free and will ultimately allow you to one day pay off your mortgage much quicker. And finally, move back in with your folks to increase the deposit you have before making your purchase. The higher your initial deposit, the quicker you'll be able to pay off your mortgage over the next 30 years. 5, work hard. The biggest lie we've all been told is that you can do anything and that all you need to do is imagine, believe and achieve. I'm sure you've watched or read all this new age stuff, and for me personally, I still remember when I got a highly commended ribbon for finishing last in my grade 5 swimming race. Here's the thing, I came in last, I sucked. I needed to be told the truth, not being given a medal for how good I was for showing up. How are we expected to take the hard knocks in life if we're always wrapped in cotton wool and told that we're God's gift to the world? It's through the pain and struggle that people become great. It's Les Brown who says that if you do what's hard in life, life becomes easy. But if you do what's easy in life, life becomes hard. And countless studies prove that by having your finances in order, it not only decreases your stress and anxiety levels, but also reduces the chances of divorce, suicide, and depression. Always aiming to be on the lowest interest rate does more harm than good for the majority of people. And it's because the fundamental problem is still there and really just kicking the can down the road. To get ahead, effort, time, and sacrifice is needed. It's through your hard work that one day those training wheels will eventually be removed. By taking responsibility and ownership, you can gain control of probably one of the most important areas in your life and begin to take pride and comfort in knowing that you're on your way to becoming financially free. It's by doing what's hard that one day your life will become easy. So now it's over to you. Are you looking to buy your first home? Did you know here at Hunter Galloway, we help people across Australia? So whether you're looking to refinance, purchase or build, you're in good hands. Simply reach out and call us on 1300 088 065 or visit us online at huntergalloway.com.au. Thanks for watching and remember to hit that subscribe button below. And until next time, I'll see you then.